In a world where everyone's trying to build a perfect portfolio that ticks all of the boxes, in this video I'm going to show you how you can build one which is asymmetrical. A portfolio that's not only exposed to high growth, but is also hunkered down and safe. Welcome back to Munch and Money, everyone. If you didn't watch the last video, I'd suggest that you go and watch that first, because this is somewhat of a part two. In the last video, we looked at how the barbell strategy can make us hit all of our goals in terms of our growth strategy and also our safety strategy. And this is an application video. It's how I would invest £100,000 using this strategy to try and maximize our output and our growth for the future. So the first thing that we're going to look at is the left side of the barbell. And if you did watch the previous video, you'd know that this is something centered very much in global funds. So 50% of our portfolio straight away is going to go straight into global diversified funds. And the one that I prefer is the Vanguard FTSE All Cap fund. And the reason that I like this fund is because it's exposed to absolutely everything on earth. Literally, if things develop across the world, you're going to have exposure to it, whether that is big tech, medium tech, small tech, the emerging markets, small caps, medium caps. This has it all. This is one of the most diversified funds I've found across the world, and I think it should make up 50% of our portfolio straight away. The next thing in our portfolio is going to be gold. Now, I know gold splits people's opinions. Some people love it. Some people hate it. Some people say it's only for boomers. Some people say it doesn't do anything. But I think having a 10% allocation to gold makes a hell of a lot of sense, especially in this market. We're currently seeing inflation through the roof, and gold has definitely preserved a lot of people's wealth over the last 5 to 10 years especially. It's currently in the early stages, I would say, of its bull market, and I think that gold can continue to run higher for the next 2, 3, 4, 5 years. It wouldn't surprise me if gold were sitting above $6,000 per ounce by the end of this decade. So gold certainly gets a 10% allocation on the left side of our barbell. Now we're going to move on to the right side of our barbell. So this is where we really want to be exposed to asymmetry, in the sense that we want to capture growth in the right markets. And this is also where we get to have a little bit of fun, and we can deviate away from the ETFs a little bit. So on the screen, you can see a pie that I've built on Trading 212. And to the surprise of no one, I currently have 33 subscribers. So Trading 212 are not sponsoring this video. But I do want to use Trading 212 in the sense that it can give you the ability to split things into allocations. So you can see quite easily, I've been able to build a pie here. You can see on the screen. And I'm able to select 8 things which I think are going to perform over the next 5 to 10 years. And in this pie, you can really have anything. So you can see that I've got emerging markets, because I think that the developing countries across the world are going to slowly nibble market share away from the US over the next 10 years or so. So that's why I'm in there. Same with uranium and nuclear energy. Same with AI and quantum computing. I think that these things are still relatively young in their development, or they're going to come back into their cycle and start taking market share away from whatever is currently the dominant market. So that's why they're in there. And then you've also got 4 stocks, which I don't personally think are going anywhere. I think they're only going to continue to develop over the next decade. So we've got Microsoft, Amazon, Tesla, and Google, or Alphabet. And you can pretty much replace these with any stock in the top 50 or even the top 100. Some people might like Meta or Facebook. Go for it. You just want to pick things that align to your overall strategy and they're exposed to growth. So, for example, if you think that we're going to be moving towards a more tech-heavy world over the next couple of decades, you're probably going to want to be investing in some of these assets, right? And that's the way to think about your right side. You want things that are exposed to growth and things that align to a narrative which you believe in. And we're going to allocate 20% of our portfolio to this for the reason that we could be wrong. And we're also capturing some of this in our global funds as well. So not only are we doubling down there, we're also being exposed to the global dynamics that can impact things across the world. And then with the final 10% of the right side of our barbell, we want things that have extreme volatility. So things that can go up significantly, but also things that you have to acknowledge could go to zero or close to zero. So for our 10%, we've gone with crypto, and specifically Bitcoin and Ethereum. If you're feeling really degenerate, you can start looking at some of the altcoins, so coins that aren't Bitcoin and Ethereum, things like Solana and things even further down the risk curve. But for me, I think Bitcoin and Ethereum does more than enough to tick the box for risk on the right side here. You If you're not a fan of crypto, you can look at things like gold mining stocks as well. So you pretty much just be doubling down on your gold, but in a leveraged manner. So if gold goes up by 10, you'd expect your gold stocks to go up by 20, 30. That's also another way to look at this. Or you can pick some really, really degenerate low cap companies. So really small companies that hit the boxes. I can't think of any off the top of my head, but this 10%, you're really allowed to go a little bit crazy within reason. And then to finally round out our portfolio, to bring us to 100%, we have a 10% allocation to cash. Now, I know that cash is melting away at 5 to 10% or whatever the inflation rate is every single year, but cash really, really gives us optionality. If our right side barbell, our stocks, our crypto drops 50% or takes a significant haircut, we have optionality to be able to use that cash to deploy at a really, really opportune time. And that can generate us growth moving into the future. So that's why I've got a 10% allocation to cash. And whilst we're talking about optionality, I just wanted to make it super clear that there's a million different ways that you can build your portfolio, and it's going to depend on your personal risk appetite and what you really want to achieve. This barbell strategy stuff is just one way that you can build a portfolio, and there might even be a better one out there for you. So definitely go away, do some research on some of the other strategies, whether that be just investing every single month in a global fund and not worrying about the right side of the barbell, or whatever it is that suits you. This is just the one that's worked for me over the last 5 years and is the one that I'm most comfortable discussing. So let's do a quick recap of where we're at. We're 100% allocated now. On the left side of our barbell, we've got a 50% allocation to global stocks, and we've got a 10% allocation to gold, and we have cash as well. If you want to put the cash into here, you can. And on the right side of our barbell, we have 20% allocation to high-risk stocks, and we have 10% allocation to crypto. That's going to give us the maximum upside exposure when we want it. So where would I actually buy these things? So your global stocks, as I've said, you can buy on Vanguard. I really like that FTSE Global All Cap Index. I think it's brilliant. It gives you exposure to everything. Gold, depending on the amount that you want to buy, you can buy physical gold through Atkinson Bullion. They just literally deliver it to your door. I suggest doing what I do, though, in terms of storage and just getting a safety deposit box at a bank. They're about 20, 30 quid a month, and it just means that, you're a lot safer, obviously. You don't really want to keep in gold in your house. It's not good. Cash, keep it in a high-interest bank account. You can get 4% interest with Marcus, Goldman Sachs, or pretty much any high street bank saving account will give you 3 to 4% if you want to keep your cash. High-risk stocks, I've already recommended Trading 212 for this because you can create your own pies, and you can allocate funds every single month with ease. It's super, super easy. Crypto, you can also buy on Trading 212, but if you really want to own the actual crypto itself, own the underlying asset, not just a thing that represents it, you're going to want to look at crypto exchanges like Kraken. That's the one that I've used for a while, and they've always been really good to me. So that gives you how you can actually buy these things should you want to. And over the next 3, 6, 12 months, I'm going to be allocating a 6-figure amount into a pie that looks very much like this, and I'm going to be using a dollar cost average strategy. So what that means is every month I'm going to take a certain percentage of this pie, probably 5 to 10%, so 5 to 10k per month, let's say, and I'm going to be allocating it into this as per the proportion that you see in the pie. So I'm very much going to be putting my money where my mouth is. I do think over the next 3 to 6 months we're going to see some volatility, simply because we've got a war going on, inflation is through the roof, the price of oil is high, and we're starting to see things crack beneath the surface when it comes to tech stocks. So I am expecting volatility, and that's why we're expecting implementing a DCA strategy. We don't just want to go all in, and then the next week, there's a new development in the war and things crash. We want to be deploying steadily, frequently, and continuously to try and capture the full price across the world. And remember, team, the goal isn't to be balanced. It's to survive whilst being exposed to the maximum upside. Thank you very much for your time, and I'll see you on the next one.